Just a couple of minutes ago until the closing bell, we have Lindsey, Stifel's chief economist with us. We're also joined by Rebecca Walser, president of Walser Wealth Management. Jared Blickery standing by to take us through the closing bell. And Jared, what are you watching here in the final couple of minutes?
Well, I'm watching the indices, but not a lot happening with them. But under the hood, we do have some action. You can see the NASDAQ off 0.25%. Everything else in the U.S. green by just a tiny little bit. Well, let's take a look inside the market, and we're going to see some kind of a mixed market today. Well, these are the financials. These happen to be outperforming. Some notable movements today. Credit Suisse up 3%, HSBC up 4%. So some of those foreign banks, as their earnings come out later than the rest, those are moving. Bank of America and Citigroup in the U.S. each up more than 1%. Wells Fargo up more than 2%. It's not just the value trades that have been doing well today, but also the cyclicals. We took a look at the industrials before, and we do have some movement here. Now, GE kind of bucking the trend, earning a little bit more cash than investors would have liked. That's down 85 basis points. That stock has doubled over the last year. Also taking a look at 3M, that's down 2.5%. But again, another COVID high flyer, that's up 26%. Moving on to the energy sector, that's also been moving here. We do have Exxon and Chevron adding to gains, each up more than 1%. Worthwhile taking a look at what these guys have done this year. If I can pull up a chart, there we go, 1 year at 28%. But check out what they've done year to date, up 36%, kind of flagging here. We'll be getting a bunch of those earnings in the near future. Also taking a look at ConocoPhillips, that's up 2%, and Hess up 3%. But looking at the sector action today, energy, financials, industrials, the value cyclical trade, all outperforming. We got energy up the most, 1.3%. And to the downside, utilities and healthcare, those two defensive sectors, those are the worst performing, down about 0.5% or more. But a little bit time left. Guess what? We're going to check Bitcoin. We got Bitcoin up 1%, around 55,000. Pretty impressive comeback over the last couple of days. And as we head into the closing bell, I'll just tell you that Ether is at a record high.
All right, put it in the record books. Here's where we're going to settle in the markets today as we are awaiting Microsoft, Alphabet, Google to report in just any minute. The Dow is going to be up about 1 point. That's where it's going to settle. But the S&P 500 is going to drop barely. It's essentially flat, down a point. The NASDAQ is going to be down about 48, 49 points. When you take a look at the sector action, as Jared was just telling us, pretty much not everybody in the green. Energy, though, was up 1 and almost 4%. Industrials up about 1%. Let's go to our guests as we wait for those earning reports. And we're going to start with Lindsey. You're the chief economist at Stifel. I got a lot of guests coming on telling us to get ready for a correction. But then I have economists telling us that this economy hasn't even hit its boom yet. That second half. What are we missing here?
Well, I think right now we're seeing the perfect equation for near-term growth. We see trillions of dollars in stimulus flooding into the economy, creating a stimulus-fueled consumer that's anxious to rush into the market, and businesses that are anxious to open up and welcome those consumers back in with open arms. So what we're seeing is this flurry of demand, prompting a flurry of production. And in fact, production now is falling short of that surge in demand, which is likely to continue to carry growth forward, not only through the first quarter, but much of 2021 for a much more elevated, much stronger growth profile than many were looking for just 3 or 6 months ago.
Rebecca, how is the market thinking about all this strong economic rebound that we're expecting, the fact that it's expected to carry through here over the next couple of months? Does the market think that we've turned a corner on the virus?
Well, I think we're getting mixed results. I totally agree with her that we're seeing mixed results. And so people are wanting to go out. The demand is definitely there, but we actually need the airlines and the cruise lines specifically and these things to reopen. But the consumer confidence in April at 121.2 is the highest we've had since February of 2020. So we definitely have consumers that want to get back in the game, get back to the concert, get back to the theater, get back to all their events. And we need that to get the economy really stimulated. We're having some employment problems. We're having a lot of people not taking jobs again. And we don't know if it's the $300 bump up that's saying, hey, by the time they get the federal and the state unemployment, they're basically making maybe potentially more than their weekly wages. So we have a lot of restaurants that are having trouble recalling staff. And so we need people to go back to work, and we need to basically get back open. And then I really do think that the demand will see us through at least until Biden's infrastructure package starts getting negotiated. So I'm looking looking at the ARP stimulus that we just got passed last month to take us through the second quarter, and we'll go from there.
Rebecca, you expect the yield on the 10-year to go higher than 2% in the next couple of months based on that stimulus and the big buzzkill that we get from Jay Powell?
Yeah, that's going to be really interesting. The biggest thing tomorrow that we'll really be looking for out of the FOMC comments are what are they looking at on the 120 billion purchase per month? Because that's the problem, right? As we organically reopen, if they overstimulate, we're going to see inflationary pressure just like we did in Q1, and some people will take risk off the table and move to safety when that happens. So we do need the Federal Reserve to be very just deliberate here about how much stimulus needs to keep coming with all. What I'm talking about is that what they're actually buying monthly, 120 billion a month, as you know. That's where we really need them to be very cautious as we continue to have stimulus bills passed through the legislature.
Hey, Lindsey, what are you expecting to hear from the Fed tomorrow? And what's incorporated in your forecast at this point?
We don't expect any policy change from the Fed tomorrow. We expect the Fed to remain at zero rates and keep 120 billion in terms of their monthly asset purchase pace. And I think the Fed has been very clear that they're not buying into this near-term acceleration of growth, which is incredibly artificial, meaning fueled by government stimulus dollars. I think it's too soon to say that if we remove the punch bowl, organic metrics will take hold and will continue on this upward trajectory to sustainable expansion. So I do think that the Fed is going to reiterate the fact that the recovery is far from complete, that the recovery we've seen thus far is still very fragile, and any temporary influx of price pressures will prove temporary, will prove transitory, and thus the Fed needs to remain in this accommodative position for quite some time. So not only will they not raise rates, so they're not even going to be talking about raising rates at tomorrow's meeting.
We're going to take a pause. Jared Blickery's got Google earnings for us. I think there are 55 billion reasons why some people might be cheering. Jared?
Jared, are you there? Yes, I'm here. Can you hear me, guys? I am definitely here. Yes. Revenue came in $55.3 billion for the quarter. Estimate was for $51 billion, so beat by about 8% there. Google Cloud revenue, $4.05 billion. Estimate was for slightly lower, $3.99 billion. EPS coming in at $26.29. Guess what the estimate was for? $11 lower, $15.64. So really blowing it out there too. Operating income, $16.4 billion. Estimate was for $4 billion lower at $12 billion. Operating margin, 30%. Estimate was 22.4%. If there's any takeaway, everything's surging here. And I can't find, at least in my cursory presentation or review of the report, anything slightly even negative, guys.
All right, Jared, and we know we're going to get Microsoft in a second. Let's go back to Rebecca. These numbers are incredible, $55.3 billion in revenue. I imagine people up on Capitol Hill are going, time to break this up.
Yeah, I was just thinking that as that report was just coming out, because we know that Google has lost market share year over year on the actual search. But what they're really doing well is they are really moving revenue digitally across platforms. Really, I think, used YouTube a lot last year through the virus and really raised the advertising profile of their entire suite of products. And so this is massively a big beat, big surprise. But definitely, I would be a little worried if I was on their legal counsel tomorrow saying, wow, this is going to turn some heads.
Lindsey, another thing that these big tech companies, big companies in general, could potentially be worried about is the proposed taxes that we've heard from the Biden administration, exactly how that's going to affect a number of these companies. Any concern just in terms of what this might do to the economic growth that we've been talking about?
Oh, absolutely. As you continue to see this insatiable appetite for government dollars, at some point we have to talk about how we're going to afford these measures. And the Biden administration has been pretty clear that they want to continue with these spending initiatives via tax increases, predominantly on corporations and the wealthiest of Americans. But we also have to remember that we're still coming out of a crisis, and many businesses are still reeling under the pressure from reduced capacity, from lingering restrictions, which add which add a number of layers, I should say, of costs and complications to the business model, which will make it increasingly difficult for them to survive going forward. And so you layer on new costs, new taxes, and I think this is simply going to compound the difficulties that many businesses are facing, particularly small businesses. But again, the Biden administration is very much focused right now on spending on infrastructure, healthcare, you name it. And there will be a cost associated with that. And the only way that the White House has proposed we're able to afford these initiatives is by slapping on corporate taxes, slapping on higher income earner taxes as well.
Rebecca, though, we had an article on, Yahoo Finance this morning, the fact that taxes really don't stop investing in stocks. Maybe you don't get the same return, but you still make money. So would it really have an impact if they slap more taxes on people?
I absolutely think so. I actually am also a tax attorney, so you probably asked the wrong person that question, because that's also a skill of mine. But I agree with Lindsey. I mean, when you look at this administration, what they're really talking about is raising the corporate tax to 28%. And then Janet Yellen specifically has been talking about all OECD countries that we need to go out to them and say, let's not have a race to the bottom, because when we raise taxes to 28%, we'll be once again the highest in the world, and we will set up a tax arbitrage situation for our multinational corporations like we had prior to the cut of the Trump tax plan. So I absolutely know that investors make decisions all the time based on tax. If you look at just New York and New Jersey and Connecticut, some of the flight that we saw, this flight we're seeing from California to lower neighbors like Nevada, Texas, people are moving to Florida from the coronavirus. A lot of the work from home. I would just give this administration a very quick caution. When you allow people to work from home, people move. And so when you increase taxes, people will change their investment practices based on taxes, capital gains taxes, ordinary income taxes, all kinds of taxes does affect policy and does affect behavior.
Let's take another pause, because the line from Twin Peaks was a damn good cup of Joe, damn good cup of coffee. Starbucks. Shauna, you got that for us, and how'd they do?
I do, Adam. We can see Starbucks shares off just around 2.5% here. Mixed results coming from the company. Adjusted earnings per share beating the street's estimates, coming in at 62 cents. The street was looking for 53 cents. Revenue, though, coming in a bit light at $6.67 billion. The estimate was for $6.77 billion. Also, comp sales. We know that this is so important here for Starbucks, just in terms of gauging future growth and also clearly how they performed in the prior quarter. Global comp sales coming in at 15%. Initially, you'd expect, hey, that's actually a pretty good number, but the street was looking for 17%. So that could be part of the reason why we're seeing shares under pressure there. Digging into those numbers a little bit more, international same-store sales popping 35%, America's popping 9%, China sales up 91% from a year ago. The estimated, though, was for a 97% recovery. Remember, a year ago really was when we saw the majority of China shut down from the COVID-19 pandemic. So the street was expecting a massive bounce back in that region. Starbucks, so it did raise its full year adjusted EPS and revenue guidance. So although not enough here to convince investors, you can see the stock under a bit of pressure, off just around 2.5%, Adam, at $113 a share.
Okay, don't go anywhere. Lindsey Piegza, Stifel chief economist, thank you for being here. Rebecca Walser, Walser Wealth Management president. We appreciate your insight as well. When we come back, we've got Microsoft earnings. We're going to pay attention to how their cloud business did. That's going to be big in just a second.